Have you ever wondered, how are Bursa Malaysia's marketplace being monitored? Would you like to know how the marketplace is maintained orderly and fair? Welcome to Bursa Malaysia. We are the frontline regulator of the equity and derivatives markets. So, what does this mean for you? Through Bursa Malaysia regulation, we ensure the markets you invest in are orderly and fair, so that you have timely, accurate, and complete information to make informed investment decisions, are able to trade in a fair and efficient environment, have confidence in your brokers to provide secure and trusted services to you. So, how do we protect the marketplace? We have multidisciplinary teams in Bursa Malaysia regulation that focus on specific areas while collaborating with each other to provide a comprehensive network of safeguards for investor protection. We also work closely with other regulators and law enforcement agencies. Real-time surveillance of the market. We have a market surveillance team that is your market police. They monitor the stock market against irregular trading activities in day-to-day trading. This team uses an automated surveillance system to monitor trading in the equity and derivatives markets in real time. Should irregular trading activities be detected, this team of specialized analysts will fact-check and engage the brokers involved for their immediate action. Supervision of intermediaries. As safeguarding the integrity of the marketplace is paramount to us, our intermediary supervision team secures the protection of your trading and deposits through consistent broker monitoring and inspection. Disclosure. Continuing listing obligations and gatekeeping of listed companies or products. To be ASEAN's leading, sustainable, and globally connected marketplace, Bursa Malaysia places high emphasis on the quality of our listed companies. This begins from the approving of new listings on the exchange, through to ensuring that listed companies remain of quality through governance and compliance, as it is imperative for investors to be well informed in the fast-paced financial world. Bursa Malaysia regulations listing and corporate surveillance teams monitor companies' corporate announcements so that they are disseminated to you in a timely and accurate manner. Enforcement action is taken should there be any failure to do so, or should there be any material inaccuracies to the announcements made. As we are also a venue for listed companies' secondary fundraising, our relevant departments work together to ensure investors' funds are always used as mandated. We have a dedicated team of finance experts to examine corporate disclosures, including financial reports, so that they are accurate and timely that you can rely on. Within Bursa Malaysia regulation, we have subject matter experts that look at the various international sustainability reporting frameworks that are constantly evolving to ensure that our disclosure requirements are appropriately benchmarked. This ultimately drives the desired improvements in our PLC sustainability disclosures as well as practices. Taking enforcement action. So what happens when the persons are regulated by us? Be they brokers, advisors, listed companies, directors, or their representatives, breach our rules, appropriate action will be taken against them. The types of action taken would depend on the severity of the breach. Suspected breaches will be investigated, and enforcement actions will be taken if the breach is proven. Our enforcement proceedings and actions are consistent and fair as cases are discussed in a robust manner through our regulatory committees, comprising independent individuals with relevant experience and backgrounds. Policy and rulemaking. Bursa regulation is the guardian to the 10 rule books of the securities and derivatives markets. Rules drawn up by the regulatory policy and advisory team are always outcome-focused. Industry or public consultations with the relevant key stakeholders will be undertaken, alongside rigorous benchmarking processes to ensure the rules are relevant, effective, fit for purpose, and on par with international standards. Each multidisciplinary team in Bursa Malaysia regulation is intertwined and interact proactively to ensure high standards in market integrity.
Can I start now? Okay. So hi everyone, welcome to webinar brought to you by Bursa Malaysia and managed by our company LifeSham. My name is Alia and I will be the moderator for today's session. Our title today is Navigating Markets with Moving Average on identifying entry and exit points. Navigating the markets can be challenging. We understand it. The chart can be subject to different interpretation, and there are literally thousands of technical indicators to give a signal. It can be confusing, but sometimes simple strategies can produce better results. Moving average are probably the most widely used indicator in trading and investing. So today, we are honored to have Ms. Pauline Yong to share with you some valuable insight on how moving average can help you make smarter trading decisions, avoid common mistakes, and build a more effective trading strategy. And before we start, allow me to make a short disclaimer. Please be reminded that everything that has been shared by this session is mainly for educational purpose and by no way we are providing you advice to buy or sell any securities. You are 100% liable if you make any investment decision. Now, allow me to briefly introduce our speaker for today, and she is none other than Miss Pauline Yong. Miss Pauline is the CEO, financial planner, and a licensed financial planner with Securities Commission license CMSRL and Bank Negara licensed financial advisor representative FAR. Currently, she Association Malaysia FPAM Johor chapter, and she is also their course facilitator for the FPAM CE courses. Pauline is the author of 5 investment and financial planning books, including the MPH and popular bestseller I Love Stock and I Love Trading. She has been a regular writer for various magazines and newspapers such as Nanyang Siang Pao, Money Compass, Chitabella, Personal Money, and others. Please welcome Miss Pauline. Hi, and how are you, Miss Pauline?
Thank you. Thank you, Alia. Hello, everyone. Good
Welcome.
morning. Well, okay. So let me share my screen now.
Okay.
All right. Okay. So today's topic is navigating markets with moving averages and to identify the entry and exit point. Okay, so welcome to today's Bursa webinar, and I'm very happy to see everybody is so energetic and wanted to learn so much about the technical analysis. Okay, somebody asked somebody asked that is this recorded? Yes, this is recorded, and it will be aired in the YouTube. Okay, so it will be available under the LifeSham and the Bursa Malaysia YouTube channel. Okay. All right. So let me continue with the slides. Today's agenda, a lot of things we need to cover. Although this topic, you may seem that it is simple topic, but then in terms of the application, there may be something that you may not know. Okay, so hopefully today's session, we are able to, every one of us, we will learn something today, and then we can apply immediately on our investment or trading. All right. So first, there are many, I want to say that for moving average, right, there are many types of a moving average, but the more popular one will be these two. Is called the simple moving average and the exponential moving average. Okay, so these are the two most common moving averages that we use. So let me explain the first one. Okay, before I start, I want to know how many of you have technical analysis background, or how many of you do not have technical analysis background? So meaning that you do not know anything about charts, you put a 0. Okay, if you do not have anything, you put a 0. Okay, Albert doesn't have. How about others? the rest all have some background on the technical analysis. Okay, Sitai doesn't have, all right. Okay, I see that some of you have some, okay? I think majority have some. So I think that will be good because then I will cater this session to a more intermediate level. Okay, it will not be too simple, but then it will be more to the intermediate level where you can apply immediately after today's lesson. Okay, good, basic, all right? So the first moving average is called simple moving average. It is really simple. It's just using the average and then divided by the sum of, for example, you are looking for 10 days moving average, then you use day 1 until day 10, the figures, the price, then divided by 10, okay? And the next figure will be day 2 price plus day 3 plus day 4 plus all the way to day 11, then divided by 10. And the next figure will be day 3 plus day 4 plus day 5 all the way to 12 and then divided by 10. So you are actually getting the average price, each of the average price, and then you form a line, and that line is called simple moving average line. And this line will be very, very close to the actual price. Okay, so something like this. Okay, so for example, this is a simple moving average line for the 50 days. Okay, by the way, I'm using tradingview.com. Okay, so for the illustration purpose, I'm using tradingview.com because I find that this is a free platform where everybody can use. Okay, so you can Google, type in tradingview.com, and then you will come to here. Okay, so if let's say you have a PC or laptop, you may type tradingview.com and then you may follow my steps together. Okay, so we can learn together. Okay, so after you have logged in, you need to register with your Gmail or any of the email address. And then after you log in, then you can use it. Okay, for the free version, you can use up to 2 indicators. Okay, so these are the indicators, meaning that moving average is one indicator. Another indicator maybe is RSI, stochastic, or whatever. So for the free version of the TradingView, you can use up to 2 indicators. However, we have so many moving averages, right? So normally I would choose the indicator known as the MA ribbon. Okay, so MA ribbon. And you see this moving average ribbon. So you click this one, then you can see that the moving average has 4 moving average here. So the default should have 4. Okay, so I click first. So let you see the original moving average. So you will see that 4 lines here. Okay, so for this ribbon, you will see 4 lines. So what are the moving average? It will be 20-day, 50-day, 100-day, and 200-day moving average. Okay, so for today's session, we will use all these 4 moving averages. Okay, and in the first glance, you may think that, wow, so many lines, so complicated. Okay, so we can focus on one line, then we can go to the settings here, and then we untick. Okay, maybe I will just use the 50-day, and then I will untick the rest. Okay, and then I click OK. So I only have one line here so that it's easier for me to illustrate. So currently I have this line, the orange color line is the 50-day moving average, 50-day. So which means that if I were to use the formula just now, it will be day 1, day 2, day 3, day 4, all the way to day 50. Okay, 50 days, add them all up together. So that means each of the price, each of these, for 50 days price, I add them all up together and then divided by 50, and then I got 1 point here. And then I get the next 50 days, and then I get another point. I get the next 50 days average, and I get another point. So then I form this moving average line. Okay, so this moving average line is based on the original price, the average, okay, for 50 days. And if let's say you are looking for 20-day MA line, then it will be based on the 20 days of the prices, and then divided by 20, and then you form another line here. So let's say I form the 20-day MA line. So this one. Then you see I have another line that is closer to the price. So this is the 20-day MA line, closer to the price. Okay, so the shorter the time frame, this is the time frame, 20, 50, this is the time frame. So the shorter the time frame, the more closer the line is to the original price. Okay, so can you imagine what happened for the 200-day moving average? Will it be near here or far away from this line? The 200-day moving average, will it be near or far away from the line, from the original price? Can anybody tell me? For the 200-day MA line, will it be near the price or far away from the price? 200-day MA line. Okay, very good. Far. Okay, it will be far. So let me click the 200. This is the 200. So I click, and you can see that it is quite far. Okay, because this is based on the past 200 days prices. You add all the 200-day prices together and then divided by 200. Then you form a point there, and then you get the next 200-day average, and then you form another point, and then you form another point. So then you connect all these points together, and then this will be the 200-day MA line. Okay, so the higher the time frame, meaning that the bigger the number, okay, of this time frame, the further away it is from the original price. Okay, now how about if I want to use a 1 hour chart? Okay, what happened to a 1 hour chart? Now this one is a 1 hour chart. Now for a 1 hour chart, I also see that I have all these lines. Okay, so but however, because I'm using a 1 hour chart, so therefore all this moving average, right, it will not be a daily moving average anymore. I cannot call this as a 200-day moving average. No, I can't. I can only call this as a 200 period moving average, period, meaning that this period is the 1 hour period. And then the orange color, this one is the 50-day, no, not the 50-day, but the 50 period moving average. Okay, because we are no longer on a daily time frame, we are on a hourly time frame, so it is called the 50 period moving average. So in this case will be the 50 hours now. Okay, and then if you to look at that 15-minute chart, okay, 15-minute chart, again, here, 15-minute chart, then you will see that you also have all these lines as well. Okay, but however, you don't call this as a daily moving average. We call it as a period. Okay, it's a 200 period moving average. So this 200 green line refer to the 15-minute chart, 15-minute time frame. So each of these candlestick will be based on the 15-minute period. Okay, so bear in mind, all these moving averages, not necessarily you have to use it on a daily time frame. You can use it in a shorter time frame, and then you can also use it according to your preference. Okay, so let's say you are a day trader. If you are a day trader, then you are looking at a 15-minute chart. If you are a swing trader, then you are looking at a daily chart. Okay, so it depends on what is your style of investment. Okay, some people they like to trade daily, and some people they don't like daily trade because they do not have the time. Then they will monitor on a day-to-day basis, and then it will be a swing trade for them. Okay, so far do you understand? Okay, if you do not understand, you have to type in the chat and then ask me a question. All right, okay, very good. So for some of you who do not have any background in technical analysis, make sure you ask as much question as possible, because the more question you ask, the better you will understand. Okay, okay, so let me go back to my slides. Okay. So then the next one I want to talk about is called exponential moving average. Okay, so the word is exponential. So obviously you have a different sets of a formula. So just now it was a simple moving average, so just an average. But this one, you are looking at the exponential. So meaning that by the concept wise, you are putting more weight. Okay, you are putting more weight to the most recent time frame. So the formula will be like this. Closing price minus the EMA of the previous time period times the multiplier plus the EMA of the previous time period. Now, first, we look into the EMA, okay? So let's say you are looking at the current EMA, then you need the previous EMA figure in order to calculate the current EMA, correct? Now, what happens if, let's say, you are using the first EMA? Because if you are using the first EMA, you do not have the previous EMAs, then what will be this figure? So normally we'll put a simple moving average here, okay? So I repeat, if let's say you're calculating your first EMA number, then this figure you need to put a simple moving average figure there, okay? And then this will be simple moving average. Then only you can calculate your first EMA. So after you have calculated the first EMA, then when you do the next EMA, you can actually use that EMA figure here. Okay, understand? Okay, then the multiplier is just a multiplier whereby it will be 2 divided by n plus 1. Okay, so this is the formula for the multiplier. So these are all pretty straightforward. It's just apply the formula only. So when you apply the formula, you can draw a line next to the price as you see just now. Okay, so just now we saw that the moving average line, simple moving average line will be like line next to the price. So when you use the exponential, it will be something like that as well. Okay, so this one I will hide it first. And then I will use exponential. I will type in a moving average first. Moving average. Average. And then you can see the word exponential. Okay, so you click exponential. And then you will see a line. Okay, so the exponential is a default 9 days, okay, or 9 period. So let me go back to the daily chart. Okay, so the default is a 9 period, so I need to change to, let's say, 50 period so that you can see better. So when you have this 50 period, then you can see that it is a line that is very, very similar to the line that we saw just now, the orange line. But this one is of a different formula, and this one supposedly to be closer to the current price. Okay, so we compare this exponential 50 to the simple 50, and then we see. So let's untick all these. So then I have the orange one, which is the simple moving average, and then the blue line is the exponential moving average. Now, do you see that they are very, very close to each other? They are very, very similar to each other. Do you see that? They are very similar, okay? And however, the blue line is actually closer to the price. Correct or not? The blue liner is actually closer to the price. So that means the exponential is actually more closer to the price. Then when do we need to use the exponential and when do we need to use the simple moving average? Does anybody know when do you need to use the simple moving average and when do you need to use the exponential moving average? Because they are actually very close to each other. Okay, in fact, there is not much of a difference. But however, if you really, really want to isolate and then say, oh, which one is better than which one, there is some reason behind it. Anybody? Is it true that EMA is better predictor of the trend? We can say that the EMA is closer to the price. So for some of those fast moving stock, like the crypto and then technology stocks, whereby it is fast moving, Forex, people tend to use EMA more because it is closer to the price. okay, when there's any fast changes or whatever, right, it will reflect better, okay, because of the formula. It put more weight to the current price. So whenever you have fast movement, then it will reflect better. But if let's say you are looking or analyzing an index, for example, the KLCI index, S&P 500 index, okay, you are analyzing some index. So for the index, right, normally I will use the simple moving average because the index is just, it's not so fast moving. So it is a very big index. So you use a simple moving average is good enough. Okay. So it depends on what is your objective. Okay. For most of the Bursa Malaysia stocks, I will also use the simple moving average as well because the stocks here are a bit slow. Okay. So you can use simple moving average. I think it's pretty safe. All right. Okay. So let me go back to my slide. Okay, so then you can see that this is the line. So you have that 200 day is always very far away. Okay, that 200 day. And then the 20 day is always close to it. Okay, so this one I'm using the simple moving average to look at the front can. Okay. Okay, so the duration. So for short term, normally the days are 10 days, 20 days. So 10 days, 20 days, we consider as a short term trend line. Okay, and the medium term is the 50-day, 100 days. So this is a medium term trend line. And for long term is normally 200-day MA line. Okay. So we can say that for short term analysis, we can just look at the 20-day MA line is good enough. And then if let's say you are looking at a longer term, you are long-term investors, you want to hold for long term, the Warren Buffett style, okay, then you have to look at the 200-day moving average. Okay, so we can say that for short-term analysis, when the price is above the 20-day MA line, it is called the short-term bullish. So when the price is below the 20-day MA line, we call it the short-term bearish. Okay, how about this one? When the price is above the 50-day MA line, what do you call this? Okay, just now, when we say that when the price is above the 20-day MA line, we call it short-term bullish, right? Okay. So when the price is above the 50-day MA line, what do we call it? Maslan, very good. Medium term bullish. Okay. Medium term. So meaning that if you are holding a medium term time frame of about months, okay, a few months, 3 months like that is a medium term time frame, then it is looking at that 50-day. Okay. And then if let's say the price is below the 50-day moving average, what do we call this? Below. Okay. Bearish, I know it's bearish, but what time frame? Medium term bearish, correct. Okay, so it's a medium term bearish. Okay, good. So then the next one is also very simple. So when it is above the 200-day moving average, we call it the 200-day. It will be the long term above, okay, a long term bullish, right? Very good. Bullish, and then this one will be the long term bearish. Okay, so if you are the Warren Buffett style kind of investor, if it's below the 200-day MA line, I think you need to either reduce your position, that means you sell part of your stocks, or you need to sell all of your stock. Okay, so normally for long-term investors, they are not willing to sell all. Okay, so then I would just ask them to reduce your position, have some money cash, okay, park some cash first. And then when the price go down further, then only you can buy back at a lower price. Okay, so this is just to protect your capital. Okay, some rules of the moving average. So basically you have the 3% or 3 candlesticks confirmation rule. say for example, you are looking at, okay, let me explain all these four first, okay? So the first one is 3% or 3 candlestick confirmation rule. The next one is you need to draw trend line to confirm it. And then the longer the time span of the moving average, the more significant it is. And the direction of the MA line will reinforce the trend. Okay, this four. Okay, so let's go to the chart. So first I want to hide the exponential, and I just want to show the simple moving average. So first, when looking at the confirmation, is that whenever you cross the MA line, right, that means that it is bullish, right? In this case, it's a medium term because this is a 50-day MA line. So let me zoom in and illustrate to you. So then here, it's a bullish. So now we need to confirm. So how do we confirm? Okay, so one is that you use the percentage. So either from 1% to 3%. Okay, it also depends on your price, you know. You cannot, if let's say your amount is very little, like a 1 ringgit kind of a stock, then maybe your percentage is also like 1% only, okay, or 2%. If let's say your price here is like a 1,200 and 40, then your 1% is already a big figure already. Okay, so you have to see what is your price range here. So the rule is either 1 to 3%, although just now I said 3%, right? But it depends on the price here. So it could be 1 to 3%. Okay, so for example, when you are here, 2.22, okay, and then you multiply 3%. Okay, so 2.22 times 0.3% is about 7 cents. So if let's say it go up by 7 cents to 2.30, okay, then you can pretty much confirm that the trend is confirmed, that it is a breakout. Okay, because this is a breakout. This is what we call technical term, if we call it a breakout. So when you break above the trend line, MA line, we call it a breakout. So this one is 3% is 7 cents. So it will be a breakout at above the 2.23 plus 7 cents is 2.30. Okay, so 2.30, then you say, okay, confirm, jump in, buy. Okay, so either this or you can use 3 candlestick. So will be the first candlestick like this, the second candlestick, and the third candlestick to confirm that it is bullish, confirm, then only you go in after the third candlestick. Okay, then you go in here, the third candlestick, after the third candlestick. So that is called confirmation. So number 2 is that you need to see this according to the trend line. So then we need to draw trend line. So let's say we draw a trend line like this. So then here is a breakout of the trend line. So you can confirm that it was around 2.26. The trend line was around 2.26, but with the 3%, it was actually 2.30. So you can see that it's roughly confirmed already, okay, if it were to manage to break out like that. And if you want to wait for the 3 candlestick, you can just wait 1, 2, 3, and then you go in at the third candlestick there. Or another way of confirmation is wait for a rebound, like a retesting of the support here. So for example, it go up, right? And then sometimes after some time, it will lose the momentum. Then it will start to retrace. So you wait for the retracement, and then sometimes the retrace will test this line again. It will touch this line and test this line again before it jump up again. So then you can buy at the retesting here. You can go in at the retesting. Okay, so there are many ways of going in. Number 1, you can go in at the breakout. You calculate the candlestick, you calculate the percentage. Number 2, you can go in when it retests the support here. Okay, you can go in here after it retests. So sometimes it didn't go below here, and then it reversed from there. So the minute you see that the candlestick is reversing, so this is a reversal candlestick, because the green bar it's engulfing the previous red bar. So this is a reversing candlestick. So that means you may go in at the reversal there. Okay. And then number 3, you look at the direction. Okay, so if you look at this direction, right, you see that this MA line is actually on an up. And then here is more like a horizontal. And then here is down. Okay, so you can see that when it is up like this, it is a bullish trend. So when the line is down, it is a bearish trend. Okay, and then, okay, let's see. The longer the time span of MA, the more significant. Okay, so you go back here. The longer the time span of the MA line. So this MA line, we are looking at the time span. So we have the shorter time span of 20 days, and then we have the longer time span of 200 days. So let me draw the 200 day here. Okay, so this is the 200 day. So this is the 200 day MA line. So what it means is that when it crossed above the 50 day, right, you are just medium term bullish. Okay, but however, the minute you cross above the 200 day, right, what is the signal to you? Is it stronger bull or weaker bull? When this cross the 200 MA line, is it stronger bull or weaker bull? Very good, stronger bull. Okay, so you can, later we'll look at the strategies. Okay, you can design your strategy such that, oh, when it passed that 200 day MA line, right, if let's say you plan to invest like 10K, so over the lines, right, you keep adding on stages and on stages. By the time when you cross this 200 MA line, right, you say, wow, all into the 200 day MA line, because it is a very strong bull. Okay, can MA use? Yeah, this is the MA line. Okay, so this is the MA line. Yes. What is your question? Your question, can MA use for the unit trust? Oh, I see. Use for the unit trust if you have the unit trust, because over here we do not have the unit trust, but we do have the ETF. Okay, so as long as you are looking at some form of a chart, moving average line can be applied. Okay, so to answer your question, it can be used for the unit trust as well. Yes, can. Okay, can. If you are able to see a chart for the unit trust, yes, you can. So meaning, back to here, meaning that when you cross the 50-day MA, you are just, okay, medium term bull, you put about 5K there. And the minute you see that, oh, it's crossed the 200-day MA line, so it's a strong bull, I put 10K there. You get what I mean? That means you add your position there. Okay, so then shouldn't trade on unit trust, right? UT is for long term. Yeah, correct. So but I suppose Steve is looking at like a long-term period, whereby if it cross below a 200-day MA line, then maybe you want to sell your unit trust, because you are looking at the long-term holding that you may not want to hold for too long if it cross below the 200-day MA line. Okay, but doesn't matter. Unit trust is actually for you to buy and hold. If let's say you are thinking that you do not want to hold for a certain time period, you can trade a little bit, but then you don't trade all. Okay, so meaning out of that 100% of your unit trust, maybe you can use about 20% to buy in, sell, buy, sell, buy, sell. It's just a small portion of your portfolio. Okay, so the way I look at the unit trust is like if let's say you have 100% and then you make 20% of a profit. So what I normally ask the client to do is that you sell that 20% profit from 10K to 12K, right? You sell 2,000 ringgit of your unit trust, and then you wait. Okay, so then when the price go down, you can top up with that 2,000 ringgit of your unit trust. Okay, so that's how I normally will operate for the unit trust. Okay. So here we are looking at the MA line. So you can see that whenever it passed through the longer time frame, it is super good. Okay. Of course, the other way, if it, let's say it passed down, that means it's bearish. So this is a medium-term bearish. And then by the time when it go below the 200-day MA line, this is a strong bearish. So can anybody tell me what should you do? This one I say you all in, right? Buy all, right? So then this one, what do you do? You what? You probably may want to sell off, probably. Okay, so if let's say you do not have the holding power, but if let's say this is like a long-term portfolio, it's a dividend stocks for you, so then no need, you just sell part of it only. Okay, because your original intention is that you want to hold for a long term, it's for dividend purpose. So even though it crossed below the 200-day, you don't have to sell all. Okay, you just have to sell part of it. Okay, unless you are looking at some trading. Okay, so later we'll look at some of the trading strategies. Okay, sometimes the MA line cross over late, by then the trend may be getting over already. Yeah, correct. Okay, so that's why for moving average, right, there are some limitation. Okay, so the limitation is that number one, it is not very accurate when it is on a horizontal trend. Especially when you are on this horizontal trend, it may not be accurate. Okay, then you see that you will be crossing over all the time. Okay, so then you have a lot of buy signal, sell signal, buy signal, sell signal. So a lot of false signals here when it is moving horizontally. Okay, so that is the biggest disadvantage. And another disadvantage is what Moody say, which is the time lag. Okay, all these moving average, there is a time lag. Because after all, you are using the past historical price to this line. Okay, so we are using the past prices to come up with an average price of this moving average line. So meaning that your moving average line is a summation of all the historical prices. So it will be a lagging one, especially when you're looking at 50-day is lagging than the 20-day. 200-day is lagging than the 50-day. Okay. To avoid the noise, can we use the weekly chart for analysis? Yes, you can. Okay, so if let's say you want to say avoid the noise, then you use the weekly charts also can. So then you look at the weekly chart, and then you look at here. Okay, so you see, if let's say the weekly chart also show that it is down, means that it has to be down. Okay, something like this. So that means it has to be down. Okay, yeah, you can. Okay, so this will be a longer time frame. So the longer time frame is for super long-term investors now. Okay, use a CIMB as example, sure. Okay, CIMB. Okay, but I would think that this kind of dividend stocks, right, it is for long term. Okay, so CIMB is for long term. Okay, so then this is the 200, this is the 50 week, this is the 200 week. Okay, and if you want to change to the daily chart, you can see that it is below the 200-day, right? So that's why Peting want me to show the CIMB below the 200-day. Okay, so if let's say you are following your rules, okay, you must have your rules. Later I will tell you how to draw your rules. If you were to follow your rules, and then your rule says that, okay, below 200-day, I must sell how many % of my portfolio, okay, whether it's a dividend stock or not. So then you just have to execute according to your rule. That's all. Okay, no emotional. The purpose of learning about the MA line, all these technical tools, is for you to invest or to trade with some rules base. Okay, you have some rules there, and then when you are investing or you are trading, you have a guideline. Okay, you have some guidance. So that means you are trading with some logical thinking and less emotional thinking. Discipline, yeah, correct. Discipline is the keyword, okay? So meaning that you are actually using this MA line for discipline purpose, okay? Because sometimes you look at this situation, right? Then you feel that, oh no, whether should I sell or not sell, you feel emotional. So then you just say, okay, like this, I have to sell certain percentage according to my rules. And then the minute when it go back up again, I just have to buy back that amount. Let's say you sell 50%, then when it go back up, you have to buy back 50%. That's all. You are following the rules. You are not emotional investing. Okay. So Maslan, is AMB a good buy now? If you look at it, okay, you have to see what is your objective. If you are the dividend base, then any time is a good buy. Okay, because if let's say you are really the dividend investor, right? Dividend investor do not look at the price fluctuation all the time. Because if you are the dividend, you focus on the dividends only. So no matter how the price move, you are not affected. So meaning when you are aiming for the dividends, right, you should not look at the price so much, and then anytime is a good time. You just have to buy on stages. So you buy some this month, the next month you buy again 1,000 ringgit, the next month you buy again 1,000 ringgit. So every month you are buying 1,000 ringgit, 1,000 ringgit. So because you are trying to accumulate your investment, okay, so that is normally the mentality I normally have for dividend stocks. Okay, I will not try to time buy sell too much for the dividend stocks, because I know that this company for the past many years have been giving very consistent dividend. So then as long as I hold for a long time, okay, so for example, if you look at the dividend here, it is 5%, 5.3. Okay, let's say we say 6% now. Okay, so we use the rule of 72. Okay, we use the rule of 72. Okay, 72 divided by 6%. What do we get? 12. So that means it will be 12 years. If you to hold this stock for 12 years, you will be getting back your capital already. So that means the longer you hold the dividend stocks, the faster you will recoup back your money in the end, ultimately. Okay, so you won't lose money in the end. If you were to hold dividend stocks, you will not lose money. Okay. Yeah, Maybank is also a good dividend. Yes. All right. So that is looking at that. Okay. All right. So let's continue. Okay. So next we go to the entry application of a moving average with the entry and the exit. So very important is that you want to know the buy signal, right? So you want to know when can I buy, when can I sell? So then the first simple strategy is that you use the buy signal as in when the price go above the MA line. It can be 10-day, can be 20-day, okay? As it go above the 10-day MA line, okay, then you can see this as a buy. Okay, so here, okay, let me okay, so there is a bit of a, let me share again. Okay, let's say you are looking at this chart. Wait a minute. Okay, so when the buy signal is triggered, when the price, okay, because I actually changed there's a typo error. When the price is crossing over, okay, crossing over the 20 MA line, okay, so then it will be a buy, okay. So when the price cross below, okay, cross below, okay, price crosses below the 20 MA line, okay, for illustration, it could be 20, 50-day, whatever, then it will be a sell signal, okay. So, okay. So when the price crosses above the 20 MA line, then followed by the volume expanded. Okay, sometimes you want to observe the volume if there's a genuine crossover or not, because sometimes it may not be a genuine crossover. So if it's a genuine crossover, the volume has to be expanded. That means increase. And then that will confirm that it is a buy. Okay, so the sell will be when the price cross below the 20 MA line, followed by an expanded volume, then it will be a sell signal. Okay, so let's take a look at the chart here. Okay, so here, let's say we are looking at here. Now, here, because it is a horizontal, so do you see that when it is horizontal, right, it is less accurate. So for example, it crossed below, then you sell. And then it crossed up again, then you buy. And then it crossed below, then you sell. And then cross up, oh no, not here, but below you are still sell. And then here you buy, okay? And then when it cross below, then you sell. So meaning, when it is horizontal, right, this moving average line, it is a lot of false signal. And how it is being useful is when it is on an uptrend like this, very clear uptrend. So when you are on a very clear uptrend, right, you can see that it will be always on top of this uptrend. So that means you are holding this stock for a long time, until here, then you will sell, okay? Here, even though you are thinking of selling, but then it's less than 3 candlestick. In less than 3 candlestick, it go back up, so you may not sell. But here you have 1, 2, the third candlestick, it go back up. Okay, so here also you may not sell, but here you may sell. Okay, 3 candlestick already, so here you may sell. Okay, so you are holding this nice chart from 5 ringgit all the way to 7 ringgit nicely. No need to buy, sell. Okay, so this is looking at the 50-day MA line. Then you only need to sell when you have this candlestick, like 1, 2, 3 candlestick. Okay, so let me repeat the candlestick again. Okay, so here I have cross around, right? So I have 1, this is the first one that crossed, 1, 2, 3, and then the fourth one, it go back up. Okay, so the fourth one actually is the time whereby you are supposed to sell. But then when you see that, hey, on this day, you see that it's going up, isn't it? You don't have to sell already. Okay, so we just wait. Zoom, see, okay. I zoom again. Okay. So here, I'm looking at this cross, right? So this is 1, 2, okay, 3, 4. And then you see that by this is still not able to cross above it, you know that you have to sell on this day. So after you sell, it go down. Then it go back up. But when it go back up, it didn't have 3 candlestick there, right? So then you continue hold. You are still selling, okay? You are not buying. You are not buying yet. You sold here, okay? You sold here, and then you have the cash. You are waiting to buy, right? So then you wait. Here, no, you wait. Here, no, you wait. Here, you see 1, 2, 3. Then you go in on this day. Okay, so you go in on this day, and then you hope that it will go higher. But however, it is crossing down again. So here you need to see 1, 2, 3. By the end of this one, you need to sell again. So that means this period, right, you are losing money. That incurs some cut loss for you because it is a horizontal trend here. Okay, so that is why for moving average, right, when it comes to horizontal trend, you are bound to have some of these kind of cut loss because you are on this trend. Then after that, then it go down further. Okay, so then you say, okay, I want to wait until it go back up to this 50-day MA line, then only you buy. So then you just have to wait until it go back up. Okay. Later we talk about the reward to risk ratio. So which means that by looking at this MA line, right, we will see that there will be a period of time whereby you have all this cut loss. It's unavoidable. If you were to use this system, it is unavoidable that you must incur some cut loss. Because imagine that if you were to catch the right wave, this period of uptrend, you can make back all the small cut losses that you have. Okay, this period of a big wave uptrend that you enjoy the big profit that you enjoy, this big profit is more than enough to cover all the small cut losses that you have. And then you cut loss here. So then you don't see this thing. Okay, you cut loss at here. So meaning that if you want to use this moving average, it is okay. Okay, to me, I find that it is okay, except that if let's say you are looking at the chart itself, if it's this chart is a very slow moving chart. Okay, because there are different types of a stock. Maybe you are looking at let's say some REITs. Okay, you know some of the REITs, they are always like same price, doesn't change. So if let's say this stock itself doesn't change, and then it's like long term, like horizontal like that, then of course if you were to use this MA line, it will not be good for you. Okay, so then you have to selectively apply this MA line. You have to see what is this chart first. If let's say this is a technology chart, maybe it is more suitable for the MA. Okay, and then so you have to see accordingly. So is this correct? 3 red candlesticks. So not only red candlesticks out. When what I mean is that by 3 candlesticks, it cannot pass the orange line. Okay, not necessarily has to be the red color. It doesn't matter what color the candlestick, but it has to be 3 candlesticks, and then you are still below the line, the MA line. Then you need to confirm that it is a sell. Okay, so here you see some green line, some red line, but you have to count 3 candlestick. Then you confirm, then only you can buy. Okay. So I repeat, I test you. Moving average application is good for what kind of a trend? Moving average application is good for what kind of a trend? MA, okay, good. All right. Clear uptrend or clear downtrend. Okay, either up or down. But if you are moving horizontally, you may not be so good to use this one, may not be. Okay, but however, if let's say you are putting it as your system, let's say you are using a system to trade. Okay, the system can be, you have your own set of rules, and then you just follow your rules, or you can have a auto trade. Okay, I know auto trade at the moment is not possible, but then in the future it may be possible. So if you have an auto trade, then you set the rules here inside the trade system, and then it will carry out for you. Okay, so meaning once it is in the system, right, then you have to make sure that if you want to use this moving average strategy, you have to make sure that the chart itself is a strong chart. For example, technology chart, or in this case, the CMB chart is also not bad, because this CMB chart is good for a 50-day MA line, because it's a banking stock. So you can use a 50-day MA line. But if let's say you are looking at some tech stock like Inari, you may find that maybe 50-day MA line may be too long, and then maybe you want to use a shorter time frame. It will be better. Okay, so this is the MA 50-day MA line. Okay. So you see that for the 50-day MA line, looks good also on this Inari. Okay, so 50-day. If you want to test out, you can also try to show the 20-day, and then you see what's the difference. And then this is a 20-day. Okay, so if you compare and then you find that, hey, 20-day is better, then you just use the 20-day. Then you just hide the 50-day. Okay, so it's, oh, this is good, then you use it. Okay, so here you have some whipsaw. Here is good. Okay, here is good. Here is good. Okay, short. Okay, hearing not good. Did you say buy when 3 candlesticks below the orange 50-day? No. When it is below means that you need to sell, not buy. When your price is above, then only you need to buy. Okay, I repeat. The buy and sell criteria is that when the price is above the MA line, you buy. Okay, when it's above, then you buy. And then when the price is below the MA line, cut below, you sell. Okay, so how many candlesticks? 3 candlesticks. You can buy and sell on the day of the third candlestick, which is the last 5 minutes trading hour, also can. Okay, because you know that for sure it is forming like this already. So you don't want to wait until tomorrow, then you go in. So then at the end of the day, the last 5 minutes, 10 minutes, or 15 minutes, you can get in the position. Okay, so P-Ting, do you understand? Muntik, very good. Above buy, below sell. Okay, very good. Thank you, thank you. Okay, so let's continue. Okay, so then this one is just looking at a simple strategy. When it is above the MA line, you buy, below the MA line, you sell. Is the trading view chart real time or delay 15 minutes? Okay, for Bursa Malaysia, it is delay 15 minutes. For the US stocks, it is real time. Okay, yeah. So sometimes we can have another kind of application whereby you use two lines application. So you can identify the possible trend reversal. Okay, so meaning that it can be a breakout. Okay, so for example, when you see that you have a 20-day and a 50-day. Okay, so when you see that this shorter day time frame cross above the 50-day time frame, buy. Okay, cross above for how many candlestick? Also 3 candlestick, buy. Okay, and then when it cross below 3 candlesticks, buy, sell. Okay, so in terms of the candlesticks, sometimes I may not wait for 3 candlesticks, because normally for this crossover is already very lagging. Okay, this is a very lagging strategy. Okay, so when by the time when they cross over, right, the price is already so far away already. Okay, and if you want to wait for 3 more candlesticks, it's even further away. So normally, if you were to apply this one, normally maybe the second candlestick you can pretty much confirm already. Okay, because otherwise it will be too far. Okay, so then let's take a look at how we can apply the MA line. Okay, so one of way to look at the MA line more meaningfully, besides the trading, okay, investing, we can look at it as a cycle analysis. Give us some insights about the cycles of the stock market. So you can use the MA line with a monthly chart. Okay, so you use it with the monthly chart, and then particularly use the 20 MA monthly chart. So if it's above the 20 MA monthly chart, you hold the position. It's an up cycle. And then if it's below, it is a down cycle. And this down cycle, because this is a monthly chart, right? So it is a 3-year down cycle here. And then this up cycle is very long up cycle. And then here another up cycle is another long up cycle down. Okay, long up cycle. Okay, so let's take a look at the real thing. Let's take a look at the KLCI. So this kind of a cycle analysis, right? Normally I like to look at the index. Don't look at the individual stock, look at the index. Okay, so this is my 20 MA line, month or daily. Okay, so I need to change to monthly. Okay, so you change to a monthly, and then you can see that if you to zoom in a little bit. Okay, you can see the red line, focus on the red line. So when it is above the red line, okay, so you can see that from here 2009 until here 2015, you have how many years of an uptrend? Except this one, there's a small hiccup. And then here you have how many years of an uptrend? 09 to 15, you have 14, you have about 5 years. 5 years uptrend. Then here you go down, and then here 7. So 4, 5, 6, 7, 3 years of a downtrend here. Then from here 7 to here is 1 year of an uptrend. And then from here down to here is 2 years downtrend. And the things goes like that. So I would prefer to use the 20 MA line for this monthly chart is because when we are in the process of holding the stocks, 1 year is a long time for us. Imagine if you hold something for 1 whole year, you feel very, very long time. Okay, so that's why I don't want to use this 200. This 200 will be too long. Even when the market crash, also you don't do anything. You get what I mean? When the market crash like this, you didn't do anything. So, but here, when the market crash, you did something. You sell here. And then when the market go back up, you buy here. Okay, so then this, at least this one give you like a big picture. Okay, it's not something that you can use it for like day-to-day kind of a trading, but it can give you some form of the direction. Okay, so you can zoom in, and then you can see that it is currently crossing. Okay, and when it currently crossing, sometimes you have to wait for 3 months to see whether it can go back up. If the second month is even down so much, that means that the third month is very unlikely that it will go back up. Okay, so but however, the second month is also horizontal, then you can continue to hold second month. Okay, the third month, because when it is horizontal, it means that there's a chance that it may go back up. But if let's say the second month is already so down already, so no hope already. Okay, 3 months of holding, yeah. Because I want to see confirmation. You see, this one, 1, 2, 3, third month go back up. Okay, and this one, 1, 2, 3, 3 months not able to go back up, you have to sell. And then this one, 1, 2, 3, okay, go back up. And this one, you need to wait 1, 2, 3. So April and May. Until May, then only you decide whether you want to hold or what. Okay, because basically these are all the top 30 component stocks, which are the blue chip stocks. Okay. Okay. Let's go back. Other application to predict the market top and bottom. Okay, so here I have one example of using the 200 MA line. So if let's say you see something like a chart like this, 200 MA line, and then you see that your chart like this, you cannot pass through that 200 MA line. Something like this. Okay, you touch the 200 MA line, and then you go down. So that means you cannot pass the 200 MA line. Okay, so normally this kind of a chart, okay, normally this kind of a chart, we call it the dead cat bounce. Okay, so the word here is called the here, okay, it's called the dead cat bounce. Okay, so how many of you have heard about this dead cat bounce? Anybody heard about this? Is this the first time you heard about it? How many people first time hearing this dead cat bounce? Anybody first time? Okay, so this is the Moodit is the first time. Okay, so you try to recognize, which means that most likely you see a double top first. When you see a double top, and then you see a line like this, the green line is a 200-day, and then it cannot pass through. Okay, so that means this cannot pass through. It means that it is the final warning to you, last warning. Okay, the last warning is if you do not get out from here, you're gonna have a plunge. Okay, so this will be the dead cat bounce. Okay, it's good to know about this. Okay. Then other application, like you can use it together with the RSI. So when you are looking at the top here, okay, and then you also see some green line of a 200 MA line showing some resistance here. So you know that basically this is a stretched already, very stretched. Okay, so no matter how well you are trying to excel here, like a momentum, you know, is trying to push harder and harder, but still you are facing some resistance here. So that means you are a bit overstretched there. Okay, and then you will see that it will come down. And then here also you see some resistance here, and then here are all top here. Okay, so here are also showing some stretched, overstretched as well. Okay. So we can apply different time frames. So as I said, you can apply different time frame. Okay. So if for bullish, if short-term time frame is aligned with the long-term time frame, example, if the price is above the 20 MA line and then in 15-minute chart and 4-hourly chart, so meaning that you open up a few time frame. Okay, so let's say you have like 4 time frame. Oh, I need to subscribe. Okay, the free version cannot give me the 4 time frame. But if let's say you have 4 time frame, like you can divide your graph into 4 section. Okay, so let's say you can divide your graph into like 4 section. Like 4 section here. Okay, so then this section here, you can put a daily time frame. And this section here, you can put a 4-hourly time frame. And then this section here, you can put a 1-hour time frame. And then this section here, you can put a 15-minute time frame. Okay, 15-minute. 15-minute time frame. So you can have 4 charts on your screen. Okay. So that's why you see some computer, right? Some people, some traders, they have a few computers because they want to see a few time frame together. So you need to look at different time frame like this. And then you say, okay, now the daily time frame, it is above my 20 period MA line. The 4-hour also above the 20 period MA line. This one also above, this one also above. So all are showing above. Then can anybody tell me what does that tell you? If all are above 20 period MA line. So what will happen? Good to buy or not? And normally when you see like this, it's supposed to be bullish, strong bullish. Okay, strong bullish. But whether it will be too late to go in, you need to analyze individual chart. Okay, so basically it is good. And what happened is that the daily time frame like this shows something like down, okay, below. Okay, so the daily time frame show below the 20 and the 200, let's say. But the 15-minute time frame showing above the 20 MA line. So what would you do? Okay, I repeat. If let's say this daily time frame show that the price is below the 200 MA line, okay, and below 200 and below the 20 MA line, but the 15-minute chart is showing above the 20 MA line. So how would you look at this? Would you want to trade? How would you trade? Anybody? Buy? Okay. You may buy, okay, you may buy, but however, you need to be looking at a very, very short duration. That means even because you are making your decision based on the 15-minute. The rest all showing negative, but then the 15-minute is showing you positive. So then you may choose to buy, but then your profit target cannot be too big. You must have like, oh, maybe just 5 points, 3 points. Very, very short profit target. And then you have a tight cut loss. Okay, because you are basing your decision based on this shorter time frame. Whereas the longer time frame is telling you, no, cannot. But this one is telling you yes. So therefore, fast in, fast out. You just have to go in and go out fast because the bigger trend is still bearish. Okay, the bigger trend is still bearish. You cannot stay in there for too long, because if you stay in there for too long, it will be coming out. You will have to stop out again. Okay, so doesn't mean that you have to align all positive then you go in, or doesn't mean that you have to align all negative then you short. Doesn't mean that. Okay, what I want to say is that you can trade with the different combination. It's just that you need to adjust your profit target, your entry and your exit. Okay, you may enter at the same timing, but the exit point is different. Okay, the exit point, maybe this one is shorter. The exit point, maybe this is longer time frame. So this one, maybe the most is that you wait for about 2 hours, then you need to exit. And then this one, maybe you can wait for 1 whole day, then you exit. Okay, so you adjust yourself based on your experience. You adjust according to your experience. Okay. So sometimes you have this mixed signal, right? So mixed signal, you will be looking at 15-minute chart showing bearish, but the 4-hourly chart is bullish. So we can say that the stock is short-term bearish and long-term bullish. So in this case, even though it is bearish like this, okay, the 15-minute chart is bearish, but let's say the 4-hourly chart and the daily chart is all bullish. So this kind of a chart, I'm actually quite happy. I'm quite happy. Why? Because I know that overall it is bullish. Okay, so then this kind of a chart, I will wait for an opportunity to buy. I will not short, I will wait for the opportunity to buy, because I know that this is telling me it is temporary bearish. So I just need to wait until it crosses above it, then I will buy. Just wait for the opportunity to buy, because overall it's still very bullish. So I would rather buy than short, long than short. Okay, another term for buy is called long. Okay, so I would rather long than short. Okay. Okay. Now, other application like this one, you can use a breakout strategy. So when you are looking at the trend line like this, breakout, but still within the trend line, so no breakout yet. And then it break again, and then now this time you break above this trend line, then only this is a trend line break, and this is a breakout, and this is a long. Okay, so with this trend line break, you may enter the next candlestick. Okay, you don't have to wait for 3 candlestick. You can enter straight away with the next candlestick, because this is double confirmation. Double. This is one confirmation, and then this is another line to double confirm it. So you already have double confirmation, so you don't have to wait for 3 candlesticks. Now, just now I said all this line, you wait for 3 candlesticks because you do not have the trend line to confirm. The trend line maybe is still very far. Then you need 3 candlesticks to confirm. But if let's say the trend line is already there, so you have double confirmation, you don't have to wait for 3 candlesticks. Okay, so these are all application. Application meaning that just now I asked, that's why I asked you guys, how many of you have zero background, and then only a few have a zero background, and majority of you have some form of a background. So therefore, this one is more to the intermediate. Okay, intermediate meaning that you already learn about the stock and the charting. Okay, so then you are able to apply it better. Okay, like pitting, you are the zero background, then you will have to focus on the simple strategy. And the simple strategy is just to look at the moving average line only. You look at the moving average line, and then you don't care about the trend line so much because you don't know how to draw the trend line. So then you just look at the moving average line. So then you are based on your strategy around the moving average also can. Okay, later I will give you one example that you base your strategy around the moving average line, whereby you no need to draw the trend line. Also can. Okay. Okay. So then you have entry and exit. So there's enter when you see that your indicators and your trend lines are aligned, give good signal, buy. Okay, so everything aligned. indicators. Like let's say you have a RSI, you have a moving average, all these are aligning well, then you can buy. Okay, and then when you enter, you need to set a profit target. Okay, and the profit target and the cut loss is 3-to-1 reward to risk. Okay, so this is a standard reward to risk ratio. Okay, so what it means is that if let's say I'm looking at enter a position, okay, and then when I enter one position, right, my potential profit is 900 ringgit. Okay, my potential profit is 900 ringgit. Then I will set a stop loss at 300 ringgit. Stop loss. Okay, my stop loss is set 300 ringgit away. Okay, so let's say I enter at this one is a 10 ringgit stock. So the 300 ringgit will be a 30 cents position. So if let's say the price from 10 ringgit drop down to 30 cents, I mean minus 30 cents, which means it's 9 ringgit and 70 cents. Okay, if it become 9 ringgit and 70 cents, then I need to stop loss. I need to sell. And then I will realize a loss of 300 ringgit. Okay, and then if let's say your profit is 900 ringgit, meaning that your profit target should be 10.9. Okay, so the minute the price reach to 10.9, you take profit, then you pocket with the 900 ringgit. Okay, so then this is a typical reward to risk ratio, which is 3-to-1. When you are doing the real trading, right, you may want to change this a little bit. Sometimes it's about 2.5, sometimes it's about 2. Okay, it's up to you. You adjust it. Okay, you don't have to stick to this 3-to-1 according to what you see in the chart there. Okay, how to use the MA when the price is far from the daily chart? Okay, so when the price is far from the daily chart, you mean that how do you do a profit target, is it? Do you mean that how do you do a profit target when the price is far from the MA line? What is your question specifically? Okay, because what I can see that there is a possibility, the timing entry. Okay, the timing entry is when you are looking at the line crossing, right? So when you see the line crossing and then you count the 3 bar, then you are able to enter already. So unless that particular trade has a gap up. Okay, so let's say it has a line here, MA line here, and then the price break out and then get up to a very, very high level. And then if you to with this gap up, and then if you to plus 3 more candlesticks, it will be very, very far. Is that what you mean? It will be very, very far. Okay, so if that's the case, right? Normally when you see a gap up, it's a confirmation. Confirm. Okay, the gap are considered as a confirmation. No, if you were to always wait for the gap up, you will never got the chance, because it's a rare occasion that you see a gap up. Gap up is a very rare occasion. Okay, you have to understand that it's a really rare occasion. So it's only when people are really, really bullish, then you see a gap up. Okay, but normally when you see a gap up, it's a confirmation already. Okay, yeah. So you don't have to wait until the gap up. Yeah, gap down. Okay, so when there's a gap down, it's also confirmed, and then the trend, and then you may short also. Okay, so it's a part of the strategy. It's called gap up and gap down strategy. So it's another strategy. Okay, so it is a strategy. It's called gap up, gap down strategy. So today we are looking at moving average strategy. Okay, and then maybe another time we look at RSI strategy, and another time we look at Bollinger Band strategy. Okay, so there are many different types of strategy, but for a new beginner, I will start you with the moving average strategy. Okay. Okay, how to use the MA? So so just now I have already mentioned that MA you can apply together with the trend line, and then you can apply together with the time frame, different time frame, and then you can apply together with the different like a RSI to see the resistance. Okay, so you can repeat the session by going into the LiveChamp YouTube channel or the Bursa Malaysia YouTube channel, and then look for this webinar. Okay, it will be posted after the session. It will be published in the LiveChamp YouTube channel. You can repeat, okay, because we have already covered all this. Okay, no, MACD is not in this cover, okay, because we only talk about MA line. Okay, so I only talk about the essence of the MA line. So I will not cover so many. Otherwise, it will take a long time. Okay, so okay. I know for technical analysis, right, there are so many things. For a normal, if you to really study well, right, normally it would take about a few months. Some of my students who follow my lesson, right, they have been following me for a few years. Then they will become better and better. Okay, then they learn better and better. So it's a series of years of learning. It's not like a 1 day or 2 day. Okay. So okay, so for exit, that means entry means you buy. Okay, you have an enter position. So your initial position means your entry. Okay, initial position. So your initial position can be a buy, or it can be a sell first. That means you sell first, you short first, then you buy back later. So this is called short. Okay, so that is the initial position. It's called entry position. So after you enter, then you need to wait for the exit. Okay, you want to close the position, you want to exit. So if let's say you enter with a buy, then when you close the position, then you need to sell. So if let's say you sell first, then your close position will be buy. Okay, so meaning that if you are using the buy, then after that you need to close the position, then you sell. So if let's say you sell first, then you buy back. Okay, so so that is called exit. Okay, when you are doing this, it's called exit. Okay, you exit the position. So how do you exit? So exit, you can see that exit, you can have two things. One is that you exit with a profit, then you'll be smiling, smiley face. You exit with a smile on your face. Okay, like the Canadian Ontario governor, they said he want to cut the energy with a smile on his face. Okay, so you will have an exit with a smile on your face, profit. And then you can also exit with a cut loss. So this one with some sadness on your face, cut loss. Okay, so then your profit will be, you can give either by points. Okay, so if let's say you are on the Forex, on the futures or whatever, right? Normally it's by points. So you say 20 points. And then your cut loss will be 7 points away. Okay, so it could be 20 points and 7 points, okay, away. Cut loss can also be relief smile, stop from a bigger loss, okay, yeah, can also. It can be by points or it can be by X amount. Just now I said 900 ringgit. And then the cut loss is 300 ringgit. Okay, so it can be points, it can be amount, or it can be your moving average or whatever resistance or your support, whatever. Okay, so all these are potential price level for you to exit. Okay, but for simplicity, I want to use points and the amount. Okay, so that it's easier for you to understand. Okay, so let's try to write down some of the rules. Okay, so now write down your system rules and follow it. So let's say we do a simple strategy. Strategy number 1. Okay, I try to be fast. Okay, I'm trying my best to, because I know the time is short. Okay, buy when price is above 20 MA line. Okay, so this is a very simple moving average strategy. And then you sell, okay, with a profit of 20 points. Hold the position until you see 20 points, then you sell. And then you cut loss with a 7 points. Okay, so this is a simple strategy. So you buy when it is above 220, and then you sell when it is 20 points of a profit, and then you cut loss when you see that you have a 7 points of a loss. Okay, so this is a strategy number one. Then another one, more advanced one. You buy when the price is above 20, 1,000 ringgit. Okay, you use 1,000 ringgit to buy, okay, stock A. And then when the price is above the 50-day MA line or 50 MA line, period MA, okay, it could be a 50-minute chart or 1-hour chart or whatever. So I use period, okay, 50 period MA line, you add the position at another 1K, 1,000 ringgit. When it is crossed above further to 100 MA line, then you also add another 1K. By the time when it's above the 200 MA line, you can add additional 1K. Okay, so then your whole position is that first you go in 20-day MA line, you add 1,000 ringgit. 50-day MA line, you add another. So this is like a staggering. Okay, you are buying into on a laddering in. Okay, scaling in. And then how do you sell? Okay, you sell when it started to be below the 20. Then you started to sell your first 1,000 ringgit. Then when it's below the 50, you sell another 1K. And then when it is below the 100, then you sell another 1K. And then if it's below the 200, you sell another 1K. But along the way, if it stop at that 50 and then it reverse and then it go back above the 20 MA line, you have to add 1,000. So that means that your buy and sell is every time is 1,000 ringgit, 1,000 ringgit, but then it's according to the MA line. If it's above certain line, you add the position. When it is below, then you sell a certain position. Okay, so then this will be more advanced, whereby you must have more money, because all this adding position is meaning that you have more money. Whereas this one is a simple strategy, meaning that one lump sum you go in and then one lump sum you go out. Okay, so these are the examples. Okay, due to time constraint, we try to have Maybank. Okay, we try to use this one for Maybank. And then let's see. Okay, let me type Maybank. Okay, now for the ETS tracker, it is under construction. So I will use the TradingView paper trading. Okay, so I will use this as a paper trading. So go to the trading panel here. Then you see paper trading. Then you connect. No, the Bursa ETS tracker is still under construction. Okay, it's still under construction, so it's not ready yet. So I won't be showing you the equity tracker. But however, I have this alternative, which is paper trading. Okay, so for the TradingView paper trading, they will on default give you 100K. Here you see that I have lost $1 is because this view is not the Bursa app. No, it is a public online website for chart. Okay, it's not the Bursa app. No, it's not. So you can buy, sell using this app, and then you can train your technical analysis skill. Okay, so let's try. Okay, so I want to move this down a little bit so that. Okay, so here, let's say this is a daily chart. Okay, let's say we use a daily chart. Okay. Now, oops. Okay, let me move this down. Okay, and then let me make it bigger for you to see. You have to adjust the scale, price scale as like this. Okay, you adjust it. Okay, so that it is bigger and clear. And then you can zoom in using this one. Zoom, zoom, zoom. And then you can see better now. Okay, so can you see better now? Okay, so you see how the price is moving now. Okay. So basically, if you are using a 20-day MA line, okay, you go to the, okay, I disconnect first, log out first. Trading panel. The bottom here, right, there is this stock screener, Pine editor, strategy tester, replay trading panel. So you click trading panel. Okay. I need to do like this. You click the trading panel, you see paper trading by trading view. So you click paper trading and then you connect. Okay. So then you see this buy sell button appear in front of you. Okay. So then you move this down a little bit. Then you see that it is nicely sitting on top of the 200 MA line. And currently it is near the 20 MA line. Okay. So let's say you want to trade on this one. Okay, because your criteria is that you are using, let's say you are using a few criteria. Okay, so let me try to draw out my 2 more lines. Yeah, let's say I want to use a multi-line indicator. Okay. So let's start with here. Let's start with the beginning here. Okay. So over here, right, when it is down, right, you need to sell 1,000 ringgit. Okay. And then when it crosses the orange line, the next line, you sell another 1,000 ringgit. And then when it crosses down here, you sell another 1,000 ringgit. So when it crosses up here, you have to buy 1,000. Cross the second line, another 1,000. Cross the third line, you buy 3,000 here. So total 3,000. Okay. So then you hold it until here, you sell 1,000. And then you cross up again, you buy back 1,000. And then you sell 1,000, you buy back 1,000. You sell, this one is within 3 days, go back up. Okay, so within 3 days, go back up, you don't do anything. Okay, so here, you can sell 1,000, buy back 1,000. You sell 2,000 because 2 line, 2,000. And then you go back up and then continue down. You sell another 1,000 because the third line down. Okay, you sell another 1,000. So then, but when you are buying here, right, you actually make some money already. So when you're selling, you're actually profit taking. Do you get it? Because when you're holding here, right, from 8 something to this 10 ringgit, right, you are actually profit taking. So you're profit taking, profit taking, profit taking. Then you bounce off from here. Okay, then you start to buy again. Okay, 1,000, 2,000, 3,000 ringgit. Then you continue hold until here you 3 days then up. Okay, so you still hold on to it. Okay, your 3,000 ringgit addition, still hold on to it. So total you have 4,000, still hold on to it. Okay, so that's how you can apply. Okay. Okay. Any questions like Peting, the new like a new zero background people like Peting? You have any questions? I do not. I do have a YouTube channel, but I'm too lazy. I do post occasionally. You can Google Pauline Yong YouTube channel, and then you should find me. Okay. I wanted to do a TikTok, but then also I don't have the time. I'm too busy. I have a lot of training. I have to deliver a lot of courses in corporate in-house courses. Okay. Yeah. Okay, because due to the time constraint, I think I will stop here. I hope today you have learned something and then you can apply immediately on your trading. Because I know that moving average to a lot of people is a very, very simple strategy. But that's the beauty of it. As simple, although it is simple, but then it is very useful. Okay, the red line can elaborate. Okay. You mean the 20-day MA line? Okay, so if let's say you are looking at the 20-day MA line, so you are looking at 1, 2, 3. The third day you go back up, then you are not selling anything. You are still holding it. Okay. You need to repeat this video. You need to repeat the video, meaning that after today's session, right? Make sure you replay the video again, and then you will remember more, absorb more things. Okay, so it's a long-term process. So you must really treat it as seriously as possible. And then once you acquire this, it's like a skill, life skill. Because trading is a life skill. Imagine if, let's say, you retired, you need some skill and to make money at home. And this trading is the best skill you have, that you can make money at home. Okay. Okay. Thank you, Rusli. I thought can sell but can hold. Yeah, in this case, it didn't cross any line, right? So you still can hold. Unless it started to cross down, then maybe you may reduce slowly your position. Reduce slowly. Okay. Because after all, this is a dividend stocks. Okay. So I will stop here, and then I will pass back to Alia. Oh, Q&A. Let me see. Can use example? Oh, just now I already answer your questions. Okay, I think I have answered all your questions. All right.
We would like to sincerely, thank you, Ms. Pauline, for your invaluable insight and wonderful sharing with us earlier. So we'll now proceed to Q&A session. Is there anything that you guys want to ask, Ms. Pauline?
Okay. Any other questions that you want to ask? You may ask now. Okay, I hope you guys learned something. Yes. Free version, yeah. Free version with two free indicator. Okay, thank you, David.
So if there's no question, we would like to sincerely thank Ms. Pauline for taking the time to respond to the question asked. I hope that all of you have accurate, new and useful knowledge from this session. May this insight shared today prove to be advantageous in your investment and trading pursuit.
Okay. All right. Thank you.
Okay. Already?
Yeah, done.
Okay.